Good morning, everybody. It's that time in which we will bring in our one of our newest traders, and that would be Brandon Mars. You know him as Option X, and I would like to welcome him in. Brandon, how are you doing today?
I'm great. How are you, Jim?
I'm doing quite well. Excited to get a little more into your strategy and how you trade. Before we get started, though, I know we had a little bit of an introduction in our trader strategy meeting, but why don't you remind everybody what the appeal for options trading is for you?
Yeah, so the appeal for me, is a big part of it is the amount of capital that you have to put up. If I'm going to be playing a breakout trade, I like the fact that you can put up $1,000 and make a nice return on that, as opposed to putting up $20,000 into that particular trade. So for me, a lot of it is the amount of capital, and I said this before. I don't do it for the thrill. I find other ways to seek thrills, but I do find them to be, maybe a little bit more exciting, maybe a little bit more challenging and stressful at times. But I definitely enjoy kind of the movements on the options a little bit more than I do on stocks. And yeah, I just like the fact I don't have to put up a ton of capital for each trade and can still be successful with it.
All right. So I think a good place to start is to go through an overview of your trading strategy. Things like what you're looking at. How do you come up with an idea during the pre market? You do a great job, by the way, of putting out your ideas ahead of time. And I know that's very helpful for our briefing members here to get an idea of some of the things that you're looking for so that when you do decide to put on a trade, they're well prepared. So great job doing that. But what goes into your process? How do you determine ideas? What type of trades are you looking for in terms of is it a function of liquidity, setups? Let's take a deeper dive into that.
Yeah, so really, I'm a chart watching technical trader. I'll pay attention to the headlines. I think it's good to know what's going on out there, but at the end of the day, things always come down to the chart for me. Um, that graphic right there is what a typical chart will look like for me. So you've got your Bollinger Bands, multiple moving averages, volume, RSI, MACD. It gets a little messy, so I took some of these off, but I'll also have another set of charts that will have Fibonacci levels, trend lines, and then I'll usually on my own write in different entry and exit points. So basically, I know which levels I maybe want to look for a bounce or maybe a level to take profits on. And again, I'll do all of that research primarily in the afternoon and the night before, just so I kind of come into the day a little bit fresher. I probably look at 100 plus charts every day, sometimes more if maybe I'm struggling to find some ideas with my usual suspects. And outside of that too, I always like to kind of run some random screens once in a while just to see if I'm make sure I'm not missing a good chart setup. Um, so a typical, like what I would look for, this is kind of an example here. This isn't maybe textbook, but if you look there, that's a chart of Apple. It's a little dated, but yeah, as you can see there, you've got a little coiling pattern, maybe a little bit of an ascending triangle. You've got nice movement there of, your moving averages for the most part are kind of trending in the direction that you're looking for. So for me, something like that would go onto my radar to buy as a potential call that day. And, for me, I would load up my different levels. I think around this time it was maybe trading around 150. And, that's been a major level. So, you've got your points and you look for your head fakes and stuff in the charts and, potentially enter into, the call at the right time based upon on your levels. So that's really how I look at a chart.
So what time frames are your favorite that you look at? Walk us through the overall process of how you nail down a timing of a trade.
Yeah, so I will, during my daily research and towards the end of the month, I'll look at a monthly calendar and then I'll break it down to the weekly, daily, and then intraday. I'm really looking at the 5 and 15 minute chart, and then checking in on the hourly chart as well. Um, so for me, I would say the majority of my trades are drilled down on the 5 and the 15 minute. Obviously the 5 for a little bit of the quicker action, and the 15 I'll look at where I'll fully admit, as a new trader, I used to get really excited. I'd see like a hammer candle on a 5 minute chart, and I'd be like, "Oh, this is going to move. This is going to move." And I learned enough of what a head fake was
Yeah.
after trading some of those. So I'll look for more of those types of setups on like a 15 or an hourly chart, and then drill down and see if maybe something's coiling on the 5 minute chart that's maybe ready to make a quick move.
All right. So it looks as though you don't trade things like the VIX or GLD. So do you stay away from a lot of the ETFs?
I do. I used to trade them. It's something I've been looking at revisiting. Actually, the SPY and the QQQ now have daily expirations,
Mm,
which I find to be kind of intriguing. For me, what it really came down to was, when I first started trading, I think you hit that first quick trade where all of a sudden you make 100% on your money and you're like, wow, these options are amazing. And then you say to yourself, well, there's, 3,000 or whatever instruments out there you can trade options on. And if I just, hit 100% on each one of those every day, I'll have my private island before you know it. So for me, it was more of just trying to be focused. So staying away from the ETFs, VIX, futures, things of that nature is just something I've tried to do to just keep myself focused. I just kind of found myself to be a better trader if I, frankly, wasn't trying to look at 1,000 ideas every day.
mhm.
It's get your couple good ideas and drill down and be focused with them. So I tend to shy away from those. It's been a while since I've touched one, and I probably won't anytime soon.
All right, that's good to know. And as far as the setup that you're looking for, it appears that your kind of go-to setup might be the ascending triangle. Are there any other in your arsenal that you really like?
I really like the flag pattern, especially if you find something like after earnings, if you get a big nice gap up and you get a big nice green candle with no wick at the top and you get that nice flag pattern. I like something like that. On the flip side too, if I'm looking at puts, I definitely like the descending triangles.
Hmm.
The guy that I learned from was I'll reference him a couple times today. He was a 25-year market maker over at Merrill Lynch, and frankly, the guy he just crushed it, and he just knew how to read charts. He knew how to trade options, and he basically taught me that anytime he sees a triangle in a chart, he drops everything and focuses on that. So that's kind of stuck with me through the years.
All right. And is there a go-to indicator that you really like say a MACD or some type of volume profile, anything along those lines?
I do like to look at volume a lot. I read an interesting line once that Wall Street has learned how to manipulate a lot of price action and a lot of things out there, but one thing they haven't learned to manipulate is volume. I don't know, maybe some people might disagree with that, but anytime a transaction is out there, you're going to have volume recorded. So I really like to look at that. Just I find it very interesting if you line up the different candles, like for example, when I'd see hammer candles before on just normal volume, I'd get all excited as a young trader. And then I realized that, like, for it to be successful, you really want to have more like 1.5 to 2 times volume. So I think that speaks volumes on that. So that's actually one that I probably use quite a bit. And then, I really like the moving averages too. Which direction are the moving averages trending? The 5 day, for example, if it's trending down, I might like certain other aspects of the chart, but might make me pause for a second. And then just simple moves, one thing I learned was just the simple 5 crossing the 10 moving average, and how when it does that, you can ride that certain trend until it changes. And, it works out quite a few times. So those are probably the two that I like the most.
All right. Let's keep this thing moving. And I know you touched on why you trade options versus stocks, but let's take a little bit deeper dive into some of that as we move along to the next slide. There we go. So as far as what you're looking for, you obviously get a lot more leverage in the options, and that's advantageous to you and your style.
Correct. Yeah. Um, so yeah, the reason that I really wanted to include this is one thing that Dame and I have talked about a lot. Options aren't going to be, and we mentioned this on the call before too. I mean, options aren't going to be for everybody. Quite frankly, they are quite stressful at times. They can be a lot of fun, but they can be quite stressful. So, a lot of the ideas that I do post, I think, are appropriate because, again, I'm looking for either a breakout or a breakdown in a particular stock, and there's no reason in the world that you can't use a stock in that particular case. Um, and I think the risk profile too. Like I said right there in the slide, I mean, you might lose 1% of your money on a stock versus 30% on an option. And when I say 30% on an option too, I'm not talking over a month time frame. I mean, it could be 5 minutes, it could be 1 minute. So on the flip side, there's more money to potentially be made there, but there is a lot of risk that's involved. So I did just want to point out that a lot of ideas that I think are very appropriate for stocks. And then there are certain cases too where, like, I find a certain setup, like Pepsi. That was one I posted this morning. I mean, that thing's kind of coiling right around its 50-day, right after earnings. Pepsi might not be the greatest option trader in the world. I've had some fun with it before, and I've found it to be really annoying at times. I mean, it's a staple. It's not going to necessarily move like a tech stock. So that's kind of what I wanted to point out on this slide. And then, it's funny, you guys were talking about Adobe today. This was an ascending triangle on Adobe from a few weeks back. So this is very dated at this point. But just for the example, you look how long that thing coiled.
Mhm.
And I think I counted like 20 days or something that it hit the upper resistance. And there's ways to mitigate that as an options trader where, you wait for that big ignition candle that you see there. But, I think as an options trader, you're always trying to time the breakout. And sometimes you get caught in those head fakes. So, granted, you might not want to have all of your money wrapped up in Adobe for that long. But I can tell you, if you'd had the stock versus trying to trade the options on it every day, you probably would have been more successful in the long run.
Yeah, and that's good to know. And I think it's also good to highlight that there are some people who might be afraid of options or are just not familiar with it. And we advocate don't do anything in the option market if you really don't understand it. If you don't have a firm grasp of what you're doing and why you're doing it, then stay away from it. However, it does sound like your strategy does translate into trading just the underlying.
Yeah, I mean, I've kind of looked at some of these trades, even a little closer than in the past, since I've been on board with you guys, and I don't see any reason why some of these aren't appropriate. And I got to be honest with you, I've even kind of thought about it in cases where I might maybe start trading some stocks a little bit more because you know you a, a formation is never guaranteed to break in the way. You're going to get your head fakes, but I've looked at certain cases where I'm like, boy, this is a really, really good setup. And I am pretty confident that this thing is going to break out, but I don't know whether it's going to be today or Monday or Tuesday. Maybe I'll just throw some money into a stock in it and let it ride. And I don't think there's anything wrong with that.
All right, and that's good. I hope the listeners do take to that because a lot of them, I will say this, as somebody who had made this mistake early trading options, it's easy to get caught up in trying to pick these options, and you do a good job of filtering these out. But sometimes, many times actually, if the premium of the option is elevated, and let's say you buy a call and the stock's moving up, yet the call's not doing anything, and sometimes it'll come down in value. And your first inclination is, well, why is this happening? Well, that's because the premium was too expensive and they're killing the volatility. So therefore, if you don't know what you're doing, you really need to have a firm grasp. And I don't think you fall into that, because the options that you choose, the weekly options, really do have a lot of the premium sucked out of it already.
Yes, I would agree. And a couple slides later, I mean, that's a very good point. And there's some good examples of that premium crush that you were just talking about that I'll talk a little bit more in a couple slides here, actually.
Sure. Now, a question we get a lot is, how do you allocate your resources on a given trade as far as a percentage of your account or portfolio? How do you do it? What's your starting point?
Yeah, I mean, I think just like I said right in the first line, I mean, I really believe that less is more, especially when you're starting out. I mean, just an example. So when we entered into, I checked on Sunday or Monday when I put this presentation together. So the Apple 155 call was costing you around 95 cents. So, you're going to get 10 contracts for roughly $1,000, and that would give you an underlying of $152,000 worth of stock. So I think sometimes people forget what the true underlying value is of how much stock you're playing with these options. So, one for starters, make sure you close out your options on Friday and you don't get assigned. I will tell you that when I was a new trader, I woke up one Saturday morning and I had a notice from Fidelity, and it was like, here's your $150,000 worth of JP Morgan stock. And I was like, excuse me, what? So, I think especially if you're starting out, less is more. There's the 1% rule out there, the 5% rule. I think 1% is good with trades. Going back to the guy that I learned from, and this was a guy who, again, did very well and would easily clear $100,000 in a day off of options trades. Not every day, but on a fairly regular basis. The most I think he ever put into a trade was 10 grand. And for me, that's going to move. If that moves for you, you're going to be pretty happy. If that starts to move against you, it's gonna sting quickly. I think his average trade was like 5 grand. And again, this is a guy who was doing this for 25 years. So there's nothing wrong with $1,000 trade. You set up your profits and your losses, and I think you get out quickly if it's moving against you. And if it works out well and you hit a typical options trade, I mean, you could easily double, triple that money. Not easily, but if it moves for you, you could easily hit a double or triple.
All right. I think one of the things that is very seductive about options trading is, let's say you put on your trade and it starts to move against you. Let's use your example here with the Apple 155 calls that you paid 95 cents for. So, hypothetical trade here, right? And all of a sudden, 20 minutes later, this thing has eroded down to 45 cents. And you're like, oh, wow, I still believe in this one. I'm going to buy it for 45 cents. And then the next thing you know, it trades at 30 cents. And it seems even more enticing, because if you get that move you're looking for, oh boy, you just really loaded up. But I can't tell you how many times that option is no good for you. So, do you fall into that? Do you get sucked into that? Or are you disciplined enough to not?
These days it's got to be something pretty compelling for me to double down. I have got to see something or have some sort of catalyst out there that is making me really say, you got to add more money to this. Because there's been a lot of times where a Friday afternoon has rolled around as a new trader, and all of a sudden I've got 30 Apple contracts, and I'm like, well, I started the week with 5 of these, and now I have an extra 25 of them that are all worthless. Like, what were you thinking? So, if you do double down and it ends up working out, it's fantastic. But I think the odds are very much against you in that case. And I would recommend staying away from that.
In the case of this Apple option that we're using as the example, what would be a stop that would be appropriate for that?
Yeah, so I'm kind of more of a believer of the percentages when it comes to options. Just because it can be a little tricky if like you're going to use, I don't know, a moving average, let's say, as support. You might not necessarily know what that options price is going to do in that drop. And yes, there's the Greeks and all that, and you can go and crunch that stuff. But at the end of the day, when you hit this volatility and things are moving quickly, you might not be crunching options pricing. So, for me, I think around 20% loss, I'm starting to say, was I correct here? 30% probably let's get out of this, and probably 50% at the most I got to cut my losses. And kind of like you were saying with the seduction of options, you also get those times where it moves against you and you're down 20%, and then all of a sudden the market spikes and you're up 50%. It's very easy, and frankly, I still struggle with it. I'll be perfectly honest with you, where you can say to yourself, "Oh, this thing's going to come back. Oh, it's going to come back." And then Friday rolls around and it has not come back. So I think kind of picking a percentage that makes you feel comfortable and really trying to stick with it is probably the best way to go.
All right, so roughly 30%, was that what
Yes.
I heard? Okay.
Yep.
So in that case, this thing trades into the 65-cent range, you're just gonna liquidate.
Yeah, I would say around there. And again, that's probably my biggest struggle as a trader. I'll fully admit it. It is very hard sometimes to cut losses on these with the prospect of them coming back. So
Mhm.
definitely takes a discipline to click your mouse and press the sell button.
For sure, and a lot of times it really doesn't take a whole lot for an option to move. In this case, 30 cents or so.
Yeah, that's definitely kind of one of the challenges, and especially too if you start, looking at trades on Thursday or even Friday afternoon, and this is why I usually put in my notes and ideas, this at this point is probably an all or nothing trade. And again, in a case like that, you should go smaller, and it should be with money that you can risk and potentially lose.
For sure. Now, let's get into something that I don't think a lot of our listeners had been too familiar with, and that's rolling options. So, you really did bring a new kind of strategic approach to this and talking about rolling into the next strike options. Let's talk a little bit about that, why you do it, and the advantages of it.
Yes. So I do it because, I want to lock in profits, reduce my risk in a trade. And, frankly, the deeper in the money in option goes, the more it's just going to trade like a stock. Um, so for me, if I'm sitting there, we're very susceptible to news. You got Fed speakers that are going to come out, or whatever economic report, or somebody might tweet something. Who knows? If you're sitting on 100% profit in an options trade, and you genuinely think that there is more upside to the stock and therefore in the option, I like to lock in that profit and get some of that money off of the table, just in case it moves against you. Because, I mean, it happens as an options trader. I remember there was one time that when Trump was in office, he was tweeting something about how, he wanted to do this and that and, destroy China kind of thing. And yeah, I happened to walk away to get a cup of coffee for like 3 minutes, and I came back and I had 100% trade that had all of a sudden turned to a 50% loss because the market cratered. So I like to roll the options just because I don't like to see those gains vanish.
Mhm.
It's very, very painful. So that is really why I do it, and I think a lot of traders do it. And then, if you're playing the breakouts, um, for example, here I'm going to talk about Tesla here. There was a question about the costs. There was this morning that I was trading Tesla, and in the morning it started out at 190 and it traded up to 210. So if you had gone into the at the money call, the 190 in the morning, and it went up to 210, you'd be sitting on a lot of gains. And at that point, the option's worth about 20 bucks. It's intrinsic value. So there's nothing wrong with holding on to an option and treating it like a stock. There's a lot of traders that do that. That's just not what I'm doing. I'm trying to play upside or downside in a stock. So if I feel that I'm going to have that, I'm going to roll up my options and I'm going to, buy into a cheaper strike, and I'm going to take some money off of that trade. Um, so on the note of the costs, I know that a question came up on this particular day. So again, this is just why I do it. I think everybody should formulate their own strategy. But for me, that day, the options that I was recommending were trading in like the $3 range. So, let's say you buy 3 contracts for, call it roughly $1,000. So to roll that up, you'd be talking about a $4 cost to cover both your buy or your sell. And at one point, if I had held on to the particular contracts that I had, they would have been up a double to 2.5 times. So for me, if I'm sitting on that much profit, I'm just personally going to pay that amount of money to roll it up and lock in my profits. And, that day in particular, that was CPI day, and we had 3 Fed speakers. So, I don't like getting caught in losing a lot of profit quickly. And, if I think that the profit's going to go away for other reasons, like the market's changing, well, then I'd probably just close the trade. But if I'm in a trade like Tesla and I'm like, all right, this thing has more upside, it's at 195 and boy, things are looking so strong. I think it's going to 200 and I want to stay with that. I just don't want to sit on those profits in case things turn against me quickly.
All right. And is there a easy way to roll?
I mean, for me at my brokerage, it's pretty easy. I have to admit, I don't know what every brokerage house is like, but for me, it's kind of just as simple as clicking a mouse a couple times, and you basically pick your strike that you're going to move up to. And I wanted to point out, it's on the slide here. A couple of questions that have come in have talked about moving up to the next strike. I just want to clarify that you are not required to move up to the next strike. You can jump up as many as you'd like. It's very common to go to the next strike. For me personally, if sometimes I'm seeing like really, really strong momentum out in the market, I might skip over one, again, just to pay less premium if I do think there's going to be a true breakout. But for me, it's really just as simple as kind of clicking my mouse a couple times and picking which strike I want. And they'll basically let you set, a credit limit, if you will. I don't know how each broker has it, but I can basically say I want to get at least $2 off of this roll if I want to set a specific amount, or I can just do it based upon the market price. I usually do it upon market price because most of the stuff that I trade is, generally speaking, got a lot of options traded on it.
All right. And then we did have a question asking, what is your charting system or your desired brokerage platform that you use?
I really like TD Ameritrade. I've been with them for a while. Despite the fact I think their system is like a 1980s DOS system or whatever, I think the Thinkorswim platform is pretty useful. I've just found it to be pretty easy as far as trading options, the information I get, and I do like the charting tools. And then I also, and I've got this in a couple slides. I use barchart.com sometimes as just a bigger reference point. And just to kind of look at something on a different screen than TD for a little while sometimes. So those are the two that I use, but trading's done through TD.
All right, great. Yeah, sometimes looking at just a different platform, a different chart, even of the same thing, you might be able to see something a little bit different. Maybe something that doesn't have all your level lines and moving averages and indicators all over it. You can see a little more clearly, and all of a sudden get these aha moments just because you looked at the exact same thing on something else. You could see it just a little more clearly.
Yeah, and I actually on TD, I actually have two charts saved for each stock for that reason because when I have my entry and exit points, it gets a little busy. So sometimes I flip over and I just kind of just like look at the candlesticks, and sometimes getting out some of that noise has very much given me an aha moment.
All right. Let's move into strikes and why you pick the options that you do. So, we're referring to the strike prices that you're going to use and the weekly options because you tend to gravitate more towards the weeklies.
Yeah, so I go with the weeklies because, again, if I'm trying to play some sort of breakout or quick move, I don't want to be paying the extra premium of going out, a couple weeks time. So, if you're going to be in a particular trade and, maybe you're only in it for 5, 10, 15 minutes because you're looking for that quick move, I just don't want to pay that extra premium by going out a couple of weeks. So, um, your moves can work in favor for you, if they go the right way. You definitely, as they'll say, have less time to repair that trade or less ways to repair that trade if it goes against you. But again, if I'm trying to find some triangle setup on the intraday chart and I think I'm going to get a quick 2-point move in the stock, and that might be my move for the day. I just don't want to pay extra premium that's 3 weeks out. And then I'm usually looking at out of the money. And again, that's just because I'm playing the breakouts and I don't want to pay that extra premium. And then, I mentioned this on the call before, but I'm not picking out of the money in attempts to get rich. Again, I think this is another place, especially where new traders get burned. You enter in with the mind frame of, oh, I'll just buy this super cheap option that's way out of the money and I'll get this big move and, I'll become, filthy rich quick. And sometimes that happens, but a lot of times it doesn't. Otherwise, we'd all be doing it. So, I'm always picking these strikes based upon some sort of, if you've got the rules of technical analysis and you've got your triangle and from, top to bottom, it's 2 points. And that would in theory be, how much the stock would then break out. I'm going to pick my strike based upon that, or maybe it's, the mid Bollinger Band might be my target level. So, I would pick that particular strike. So there's always a method to the madness behind it. For example, I wanted to point out on this chart right here. That's a chart from Shopify on the last post Fed day. So, if you look at that chart there, where I have circled, you had a little bit of a coiling action for a couple of days. The Fed came out, the high growth tech stocks, all were through the roof. And we were in an environment where there's a good chance for, a potential gap up that next day with continued momentum. And, when a name like Shopify or high growth, when they get that momentum, a 2, 3, 5% move is kind of normal. So, around that day, I've been kind of coiling there around 50, pretty key resistance level. You've got the momentum in the market. For me, I'm probably not going to pick the 50 strike there. I'm probably not even going to pick the 52 or the 53. I would look at volume, see if I saw anything that kind of caught my attention. But, I'm probably going to be at least a couple strikes up from the current price. And, It doesn't always happen, but if you look there, I mean, Shopify gapped up and I think it hit, 55, 56. So, maybe talking conservatively, you go with the 53. And if you're right, it gives you the opportunity to maybe trim or exit or roll up to the 55 or the 56. So that's kind of my thought process on how I would pick the strikes.
Okay, so you don't go too far out of the money. It's almost like the strike that's somewhat close to where it's trading, but still out of the money.
Yeah, I would agree with you there. Maybe sometimes I see something where I'm just like, this thing is just, you know, you'll have like a moving average or something where it's just kind of going to be like drawn to, potentially hitting that level where I might go a little bit further out. I would rather in a case like this, I would rather pick like the 53 strike on Shopify, thinking that it's going to move to hopefully 55, and you kind of meet in the middle, because in that particular case, I'd rather have myself be correct and be closer to the 53 than be too far out of the money where even off of a big move, you don't make any money. Because I tell you, I've gone too far out of the money before, and like all of a sudden you look and you get this stock that moves like 10%, and you're like, why is my option losing? And
Mhm.
that is very frustrating. So I'd rather bring it in a little bit more and give myself the flexibility to potentially roll up.
All right. And as far as one question that I had for you is, how do you feel about the unusual options activity? I'm sure you're familiar with, Dr. J came on and he made a big deal about this, several years ago about the option activity, the big put buying or the big call buying, and they're always long every time that happens, of course, and they tell you the next day. But how do you feel about it? And do you use that as part of your strategy ever, or hits or misses on any of the attempts that you've made on that?
Yeah, that one I feel can be very hit or miss. I don't necessarily on a regular basis go seeking it out, because I feel like that's where I've been burned, where I just like, oh wow, this option's traded 10 times normal volume. I
Hmm.
gotta get on it. And I feel like that's where I lose. I mean, I've seen days like Starbucks is one I've seen some really unusual options activity on before. And, one day I've seen 10 times the call volume and the thing, skyrocketed. And then the next time I see 15 times call volume and it's plummeted. So maybe when I'm searching, if all of a sudden I see like a particular strike that's got some high activity and I like the stock as it is. So usually for me, it's, if let's say I'm looking at 10 stocks in the day, and all of a sudden, I like all 10 of them, and one of them has like this huge amount of options activity. Well, I might maybe bump that up the top of my list, but it usually ultimately starts with the chart for me, because I have followed some of this unusual options activity, and I don't think it makes sense. I really don't. I mean, I'm sure people would disagree with me, but I think it's really hit or miss, and I try to not chase that action in particular. Maybe sometimes if you're going into a particular event and all of a sudden you see this massive inflow of activity in the last 5 minutes, like very, very high, like institutional type buying, that might get my attention a little bit more. Um, but other than that, I almost feel like it's trying to throw darts at a dartboard. So it's not my main objective.
Yeah, it is tough. And mostly because you don't know what that trader or firm is doing. You don't know if it's a hedge. You don't know if it's an outright position, and it could be just somebody out there found a lot of volume and they're selling into it, and that could have been that case for that high volume Starbucks trade that you were just talking about, where somebody might have been very savvy and said, "Oh, look at this," and ends up selling those options and it ends up tanking. So you just don't know the objective. And I think that's where things get lost on some of that unusual auction activity. So,
Yeah, and I think some of the times too, I mean, sometimes you get those alerts on stocks that frankly don't have any sort of options volume for the
mhm.
most part. And all of a sudden you get this like random block of, 2000 options that were traded. And I would agree with exactly what you just said. You never know. I mean, that could just be an institution that's just hedging a big position or something like that. So um, I just take it with a grain of salt.
For sure. All right, now let's get to these binary events. Now, this is something that as a trader, I have not. One of the things I preach is know thyself. And one of the things I know about myself is that I'm not good during the big market moving events immediately following. I'm a whole lot better after the dust settles. So I would get, I don't know, emotionally tied. I always struggled with trying to figure out the appropriate risk reward during that emotion time. And I just came to the conclusion I'm just not good at it. So therefore, I'm not going to do it. Here we are talking about binary events. So, what's your strategy around the Fed events? Are you trading into it? Are you flat? What's your overall takeaway from how to trade those?
Yeah, that makes me feel a little better to hear that from you because they are stressful, and they can be tough. So, binary events for me, as I say here on the slide, I mean the Fed meetings, the jobs reports. These are things that I might be a little bit more likely to carry something into. And the reason that I am more likely there is I usually try to watch the activity leading up to it. Are we accumulating? What do the candles look like? Is there a big hammer candle out there where, they've been dropping the price and, we're thinking that the Fed's going to be the catalyst to make it soar. So I feel like there's more things that I can potentially try to piece together there to trade around one of those events. Plus, the premiums are going to be, they're going to be cheaper than around like an earnings event. So, they might be elevated in the market in general, but you can still go out and, maybe you're paying 10% more for Meta, not like a huge number. And, the move would cover it. So for me, it's do I have a gut feeling? Have we been, moving down or the reversal candles on the charts? And is this jobs report going to come out and everybody knows that it's going to be weak or strong, and we're finally going to have that reversal. So I always want to make sure though that I have a kind of a particular gut feeling on it. If I'm just completely lost and the market's been chopping for 5 days and I have no idea where it's going to go, it's just not worth it. Like you said, I'll jump in after the fact. Um, so definitely more likely to trade around those. Earnings is something that I rarely trade options on. Into the week or during the week or into the actual earnings report. And those are where I can share your frustrations, I would say, is, you've got your two layers of risk. One, which way is this stock going to go? And I mean, I think we've all read the earnings reports. They don't always make the most sense. It's like a company, beats guidance and they raise guidance and the stock tanks. So
Hmm.
you got to pick the direction correct. And then, the premiums on these too. I was looking at Carvana going into earnings yesterday. That had 900% premiums on it. So, the stock has moved 16% today. You've barely made any money. It's the option sellers that have made the money there.
Hmm.
So I just got frustrated with trying to one, pick the direction, and then, buying a call option on something and the stock goes up 6% and you're flat on your option because the premiums are so high into earnings. So I don't touch them. I know, and this is why I put this in there. Um, yeah, I know that somebody probably hit a big meta trade recently on their earnings. And when you hit those right and you get that huge, soaring stock, there's big money to be made. It's just become a stress for me that I haven't wanted to deal with these days. Um, yeah, and then as far as binary events, these aren't binary events per se, but I wanted to at least put them in there, as far as my trading style. So, the first 30 minutes of trading is definitely not a binary event, but it can certainly feel that way when it comes to options. I mean, I think case in point yesterday, and I don't think I was alone in these thoughts. I thought that we were going to see a little bit more of a bullish market after Nvidia. We had pulled back, people all excited about Nvidia and the semiconductors, and I thought it was going to be a little bit more bullish. And if you jump in on an options trade right out of the gate, those can quickly turn against you. That first 5 minutes of trading, that nice green bullish candle can all of a sudden turn into a reversal, shooting star type candle. And that can quickly change things for you. So, I've probably been recommending things a little bit less than the first 30 minutes. It's tough because if you hit things right in the first 30, you can double your money in 5 minutes. But if it goes against you, so I've been a little bit more of a fan of kind of going back to what, you were saying about events and kind of watching that price action. And then the last is, good example. We're here. We are on Friday. A lot of options traders call trades on Friday lottos. You're either going to enter into that and it's going to move for you and it's going to be a nice return, or it's going to move against you quite quickly. And unfortunately, your option's about to expire in a couple hours. You might not be recovering on that trade. So it's one that I like to do. I think a lot of options traders do. I prefer to do them a little bit more if the week's been good and I've got a little bit of money on the sidelines. That's profit. If I'm down for the week, I don't want to necessarily try to dig myself out of the hole with a Friday lotto. It's tempting, but I try not to do that.
How do you find those lotto trades? Because what I've experienced is that for the most part, I think that the option market makers love to dangle those to the retail traders because typically on a Friday, volatility dries up. And the way I always put it is they're going to be damned if they're going to give you some free money.
Yeah, you learn quickly in the options world that they don't like to hand out free money. So, for me, how I would find them, good example, and I called out Tesla earlier, and I'll just say this because I'm on the microphone here. I mean, the 195 calls that I had mentioned earlier, almost up 50%. So, might want to start thinking about taking some profit there. How would I find them? If you look at a stock like Tesla, since I'm on it, Tesla has been the strong stock. It's kind of just, it's pulled back a little bit of a flag pattern, but it's kind of just been chopping around here, holding up pretty well, even when the market's held back. Well, today it dipped down below its mid Bollinger Band. It's got the wick that it's, moved back above it. Um, we've got a potential for a squeeze in the market after a couple of days down. And then, I think it's just a matter of looking at the market and saying, all right, the market's been down. You had the semi news yesterday. We're maybe hitting some of these key like 200-day levels kind of all at the same time. And you say, all right, well, how many people piled into puts? And I think at some point, the market makers, like you said, they're not going to hand out free money. So what are they going to do? They're going to burn the put holders.
Yeah.
And I think when you start to see some of that behavior, and yeah, a day like today where it felt really heavy, but then it kind of started to slow, and you maybe start to see some long wicks here and there on the charts. You maybe start to see, maybe a couple things start to show some strength. You got little things like Square. We got some green, CrowdStrike in the cybersecurity space. My particular watch list of like 150 names a little while ago, it only had 3 names in the green, and now we're at like 20. So that's not huge, but that's building. And I think when you start to see those things, I just try to gravitate towards what was maybe the strong stock out there, or like a Tesla. It's a tough one to bet against, and it's been strong. And look at that, it all of a sudden takes off with the rest of the market. And it's moved $3, I think, since we started talking. That can make a pretty nice options trade when you get that kind of move on a Tesla on a Friday. So that's how I find them.
All right. So would you say that those lateral trades are more towards the call side versus the put side?
Um, I would say generally speaking, yeah. If I see the market kind of on the flip side breaking down on a Friday, I'm definitely not opposed to buying a put. But some of these Friday squeezes
Hmm.
have been quite fun. So I would say probably leaning a little bit more towards those, but I'm definitely not afraid to take a put if I see the opportunity.
All right. Let's talk a little bit about profit and loss here. How do you decide what your profit is going to be? Is it something that you predetermine or do you let the market tell you?
Yeah, so I mean, it's a little bit of both. I mean, I'd say on the losses, it's probably more of the predetermined. I mentioned those levels earlier when we were talking, and I have them there again. As far as on the profit side, and I gave this example before, I was in a trade on Marvel, and the option was up like 80%, and it was approaching the 200-day moving average. The market had been up most of the day, and we were getting to the point of the day where you might see that afternoon profit taking. And I was approaching my target level. I was up 80%, and I just said, you know what, I'm getting out. And it doesn't always happen, but of course we hit the 200-day and you saw some selling. And if I hadn't gotten out, I would have given back like 40-50% of my profit. So the reason I bring that one back up again is I was thinking about it recently. And as a new trader, once you hit that first 100% trade on options, I think you get it in your head like they all got to hit that. And for me, in a case like that, I think it's important that if the market's changing or you're hitting your target levels and you're only up 50, 60, whatever, even 20%, you don't have to squeeze 100% out of each trade. So that's kind of why I wanted to mention, that one again. And, I think also asking yourself too, like, what losses can you handle? That's the most important part. And then on the flip side, I felt kind of funny writing this question out. It just seemed funny to me. But what profits would make you happy? And I wanted to jump back to again Tesla. This is from this chart down here at the bottom. This is from a call that I had mentioned in the room from last Friday. And if you see those two shaded ovals there, that was when I called out the buy and called out the sell. So that moved from $1 to $2 in about an hour. So on a Friday afternoon lotto, you've doubled your money. Now, unfortunately, it moved up to $6. So obviously that can make a big difference. And I wish I was in it longer. But you got to kind of ask yourself, I guess, like what makes you happy with profits sometimes. I called out an AMD trade yesterday and it immediately spiked up like 40%. And unfortunately it then moved back against you. But at 40%, making that kind of money that quickly, that can really be a game changer for some people. So, I don't think there's any problems if you want to just, press that sell button if you're happy with a trade or you're not feeling good about it, to take your losses and just get out of Dodge. Um, and on those Friday lottos, if you look at that chart too, if you rode that all the way up to 6, I mean, you're feeling pretty happy, but it did pull back. So here on a Friday afternoon, as you head into your weekend, all of a sudden it did go from 6 to 3, and I think less than an hour. That can be very painful and stressful. So, I think, again, I think it all comes down to everybody's personal choice. But I think these are kind of some of the things that you need to ask yourself as you formulate a plan.
On average, do you tend to take profits or losses based on the option price that you paid or looking for, or what the underlying is doing?
Um, yeah, I mean, I think it will sometimes be a little bit of a combo. If I do get onto a trade and I'm all of a sudden up a quick 50%, like this Tesla option I mentioned earlier, that's up about 50% now. And like let's look at the 5-minute chart on Tesla. All of a sudden you got this hammer or excuse me, a shooting star candle. The stock has just moved from 194 to 197 in, I don't know, an hour, give or take. We were kind of shaky this morning. Do I think that there's a further potential for a squeeze? I do. 197 is a pretty key level on Tesla. It's Friday afternoon and I'm up 50%. I'm probably thinking profits, so that's a combination of both percentage and what I'm seeing out there. And then anytime I think you get up 100% on a trade, I don't know. I tend to maybe start to get a little shaky of like, oh, don't want to lose this, don't want to lose this. So, maybe I'll take a little bit off the table, maybe I'll roll it. If the market's just really zooming and I haven't hit, any of my resistance levels on the underlying, maybe I let it ride. So it's really just kind of a combination. For me, the main thing is protecting myself. Like in that Marvel trade, I don't know. It was looking good. It was a strong stock, but I've got my resistance levels that I have set in place coming up. I'm thinking the market might have a little bit of a pullback. It's like, you know what? I'm just going to get out. 80%, I'm happy with that trade. And you know what? The key thing is you can always re-enter an options trade. Always. So, I'd rather protect myself and re-enter. It costs a little bit more, but I would rather do that than, risk a trade moving against me.
Do you need to take a pause to take some profit in your Tesla trade?
I'll be honest with you. This is actually my favorite trade so far because, I could just call it out in the room.
Yeah, all right. Well, I mean, it's up to you. Feel free if you need to. Hey,
the, the,
take a
ti-
little break. People will they'll be okay with you taking some profit as they're taking some profit too. So just
the
so you know,
timing
you have
of it and
permission.
just how that, particular candle lined up was just kind of fantastic. I couldn't have asked for any better, to be completely honest with you. So,
Now, I do have a question regarding implied volatility. So this is baked into the options price. How often do you look at where the implied volatility is versus historical or an average basis?
yeah, so implied volatility is probably one of the biggest things that I look at. And we talked about this before when I was on. Once we start getting to call it 100% on the implied volatility, I kind of start to maybe question how much movement is there. Um, it's not going to always keep me away from it. Touching Carvana for 800% IV going into earnings is just something I really don't have any desire for. So again, I'll start with my charts. I find my ideas that I like, and then from there I'll look at IV. Kind of secondary, and kind of like we were talking about earlier with the open interest. I'll kind of find that secondary where it always starts with the chart for me. And I like to look at the IV because it's saved me a lot of times, because if you see these elevated premiums, sometimes you can say to yourself, is something going on? And again, I don't like to trade earnings or certain events. And all of a sudden I've been like, oh, why does this stock have double the IV of usual? And then you go and look and you see they have an investor day, 2 days later. and maybe that becomes a tradable event, but I think it's also, a potential red flag for you. Maybe not red flag, but it's a warning for you of, hey, there's something going on. There's something you need to be mindful of. So actually, just simply looking at IV has actually saved me a lot of stresses on some of these events before. That's for sure.
Okay, so but there isn't anything in your strategy where, let's say, the average is, say, 15 and it's trading, 8. Do you find that option, "Oh, that's a good one. I wanna take advantage of that because the implied volatility is less relative to, the historical level?"
Um, yeah, I mean, I have tried to take advantage of that before. Me, it really comes down to the charts again a lot. It's more of like if it's a huge amount, if it's like, all right, well, the typical IV is, 100% and we're down at 20,
Mhm.
like a really big move, then I'm kind of intrigued. But for the most part, it's really just comes down to the chart setups for me. And then I know we talked about this a little bit before. I don't ever change my strategy to sell options.
Mhm.
Selling options is just not something that I do. Um, there's some risks involved, but you could have done pretty well by selling some premium on Carvana yesterday. Again, a big risk because that thing can zoom higher or lower pretty quickly. So there is opportunity. It's just not something that I do in particular.
Alright. So, typically, you like to day trade options and, if you can get in and get out, you keep your risk in check. However, there are times in which you need to carry something overnight. So, why do you take that risk? What leads you into that? And walk us through a trade that you would carry overnight.
Yeah, so overnight, a lot of risk, a lot of reward, really. For me, if you look, I'm going to go back to like that post Fed day. There was a lot of momentum there, and things were very, very green. And just seeing events like that before, that next day you have a higher probability of a potential gap up. And if you play one of those gap ups correctly, I mean, it can be a very, very big trade right away. So that's the reason that I do it. And again, on that post Fed day, a lot of these stocks moved up and then a lot of them just consolidated for the day because it was a 2 day move at that point that was pretty big. So a lot of times if you didn't hit that out of the gate, it made it a little tougher to make money. Not saying it was impossible that day. It wasn't by any means, but it was tougher. So that's one of the reasons that I like to do it. I don't necessarily make a habit out of it, but, I do it quite a bit, but I tend to do it cautiously because, I think if you looked at, I think it was when Powell was speaking at whatever luncheon event, we got a really nice spike up after that. And it really felt like that was going to happen again the next day. And I think a lot of, traders out there were under the same impression as me. And, we just didn't get that. So if you had done it in that case, you kind of fell flat. But I like to do it because, it can be a nice way to start the day if done correctly. But if it moves against you, you could be looking at, 100% losses. And when I do it, I definitely think it makes sense to trim or exit or roll, sooner rather than later out of the gate because if the market gaps up real quick and then it has a quick fade, it really stings and just doesn't get your day off to a good start. If have a double go to a loss at 9:35 in the morning, that just does
Mhm.
not feel good.
For sure. All right. And as far as options that you trade, you kind of stick to your wheelhouse. What are some options that you just won't trade?
Yeah, so I mentioned Carvana a couple. You look on the far right there is the IV. You're talking 200% plus, and this was from last week, so it didn't include the earnings. So those are much higher. So again, I'm not necessarily going to fully stay away from those, but it's got to be a pretty intriguing opportunity, just because it does get a little frustrating to have your options move a lot, or to have the stock move a lot and have your options not move. It's part of the pricing, so it shouldn't be a shock, but it just can be a little frustrating. The other option chain there is AutoZone. And if you look at the volume in the open interest column, I mean, there's basically just nothing traded on it. And then if you go to the bid ask, I think some of the bid asks on there are like $5-10 each. For me, there's so many other securities out there that have, you know, better option chains, in my opinion. I have just stayed away from those. Again, that's just me trying to focus and try to make my life a little less stressful when possible.
All right. So, as far as anything else you want to touch on, some parting shots for our listeners, what are some of the things you want to really drive home?
Yeah, so definitely, as you also, I couldn't agree with you more. Know the basics of options before touching them. I can't stress that enough. Know your risk in your trading plan. I think kind of going one and the same. Again, very, very much stress on the losses. I really wish that when I was a new trader that somebody had really explained to me the losses more. And I understood them, but more stressing like, hey, Brandon, you can't, end your week with, 15 worthless contracts. You're gonna kill your portfolio and you're gonna kill yourself. So um I really wish that somebody had stressed that to me a little bit more, because it is very, very easy to get sucked into a situation like that. Um, we talked about the exciting option volatility book that I think was your favorite. You said, as much as you read in a book about the math and the funny math symbols that are scattered throughout that book, there's one thing and again, it's a huge book. It's not going to teach you discipline. It's just not. It's not going to teach you that discipline of, I need to click my mouse and take my profits, or I need to click my mouse and I need to take my losses. So, that's probably one of the biggest challenges of options trading is that discipline, and you're just not going to find that anywhere except for, I think really looking in the mirror and also making your own plan. And then, of course, and very timely, because it's Friday, always close your options before expiration date. As much as a great leader that I think Jamie Dimon is, I had zero desire to own $150,000 worth of JP Morgan stock when I was assigned as a new young trader. So definitely make sure you're closing out those options unless you want the shares. And again, make sure you have enough money in your account for that.
What
Um,
happens if you do not? Let everyone know what happens if you don't.
it's been a while, knock on wood, it's been a while for me since that has happened. I believe due to the explosion in options trading that there have been policy changes. Um, for me, it was kind of a weird situation where I think they flipped me over to margin and let me hold it. I will tell you that I had a friend of mine recently who didn't know how to fully trade options. He got assigned a pretty big block of Tesla shares, and he ended up having to call them, and they had to go through this whole process of like some weird reverse selling and buying of the shares, and that alone cost him $5,000.
Yeah.
So he called me at 4:01 on a Friday and said this happened, and he's like, I got to call TD. And he called TD. He had lost $5,000 in that 30-minute phone call because they did some weird buying and selling to cover the shares and work with the contracts. So it was not a good situation. So again, I'm sorry, I don't fully know because I think they've changed some of their policies because a lot of people have just frankly been closed out of options. And then actually, that reminds me, um, don't count on your broker for this because I have found that the brokers to be very, very choppy in what their actual policy is on this. But a lot of brokers these days, if you have options that are in the money or near the money, close to the Friday close, they will actually automatically go in and close those out. Um, I think it saves a lot of people. It's driven me nuts sometimes because I'm pretty prudent when it comes to watching my options. But just as a warning, if you're, trying to buy an option at 345, thinking we're going to get some big spike at the end of the day, your broker might come in and just kill that position on you.
All right. Well, I guess the bottom line is just don't do it. Let's not find out.
Yes. Your summary was much better than mine. You're correct.
All right. Well, again, I think we pretty much covered your strategy. What I will tell our listening audience is I'm pretty sure Brandon would be happy to ask or, excuse me, answer whatever questions you may have. But the key is to leave your email. Otherwise, you risk a good chance of us not seeing it, or maybe you didn't hear it when we answered the question. So it's always best just leave your email, and Brandon will do his best to get back to you on some of the more specific questions that you may have. With that said, Brandon, I want to thank you for jumping on, going over your strategy and telling a little bit about, some of the battles that you've had with options in the market. It's always good. And uh, I can promise you that you'll most likely be on here again. We'll come up with tons of things that we can discuss. And again, I want to thank you for your time. And I'm sure I speak for the listeners for your input as well.
Thanks, Jim. I really appreciate your time today and having me on. And yeah, look forward to hopping on and answering any questions that anybody might have.
All right, great. All right, well, I'll let you get back to making some money, and we will talk soon.
Thanks, Jim.